The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Hello, and welcome to a brand new episode of the Fed15 podcast presented by Serving Those Who Serve. Each week, you know that we are here to discuss the latest news and information that feds need to know in 15 minutes or less. So whether you are a seasoned federal employee or whether you are just getting started in your career, Fed15 has got you covered. Make sure you grab your coffee, your water, important to stay hydrated. Kick back, and we'll tell you what you need to know but might have missed in the federal space this week. I am your host, Katelyn Murray. Again, Dan is enjoying his vacation. We are so happy for him. He never steps away like this, and so we are so glad. I'm so glad that I could finally convince him to take a vacation, guys, to be completely honest with you. So we are wishing him well and hoping that he is enjoying his time, and he'll be back with us next week. Never fear. The bears out there in Montana haven't gotten him yet, dear listeners. All right, so we've got two different articles to go over today on the STWS website. And this is like, I think that this is kind of primo Fed15 content. We've been through a rough year with 2025 last year, even the beginning of this year. Lots of kind of like urgent alerts and updates and things that are coming out and very difficult, turbulent times for feds. We're kind of getting back to basics on today's episode because the two topics that we're going to be talking about today, we've got an article on IRMAA, which I think is a great piece that everybody should take a look at on our site. Certainly if you're getting into your 60s, very highly relevant for you. And then we have another piece on tax planning. And I know that this is always something that's very much of interest with our feds. So getting into IRMAA here, if you've never heard of IRMAA, it is the Income-Related Medicare Adjustment Amount. That's what IRMAA stands for. And what it is an additional premium that is added to your Medicare Part B and Part D based on your income. Okay, so everybody, hopefully, you know that Medicare Part A is free. Right? Medicare Part A is your hospital coverage. Once you turn 65, you can opt into that. There's not a payment that's required for that. It is free for every American citizen. Okay. Medicare Part B is optional. And because it is optional, it comes with an additional premium amount. Part B covers non-hospital medical related expenses. And then Part D stands for drugs. Part D is your prescription drug coverage. Many feds choose to forego the Part D coverage because you guys, if you qualify, if you've been enrolled in FEHB for 5 years prior to your departure from federal service and you retire under qualified retirement, then you've got FEHB in retirement, and that largely is covering a lot of those prescription drug costs. Again, I'm not making recommendations here. I'm just kind of talking through, how everything fits together in the overall picture. So when it comes to this IRMAA, it does affect both Part B and Part D, but in most of our work with feds, we're looking at the Part B impact to people. Now, IRMAA is based on your income, but it's based on your income for 2 years prior. So let's say you are 65 this year and you were going to sign up for Medicare. And let's say that you want to sign up for both Part A and Part B. So you are going to have some sort of Part B premium that you're paying every single month for that coverage. They would look at, this year being 2026, they would look at your 2024 modified adjusted gross income. And you can find that on your tax return. All right. So your 2026 premiums for Medicare Part B and Part D, for that matter, would be based on your 2024 modified adjusted gross income. Now, what does modified adjusted gross income include? Well, you can find some examples of what's included in the modified adjusted gross income in the article, but typically it's going to be your adjusted gross income, your AGI, plus tax-exempt interest gets added back in, stuff like tax-exempt interest from bond funds in a brokerage account. Student loan interest deductions get added back in. Interestingly, traditional IRA contributions, not your 401k or your TSP, but IRA contributions added back in there. Large TSP withdrawals can be impacted. Capital gains get added back in, those sorts of things, okay? But in general, that modified adjusted gross income that you're seeing on your 2024 return is going to be what determines your 2026 Medicare additional premium amount, right? Your IRMAA. And that scales up, right? So there's a 2-year look back. Just remember 2-year look back on that. Now, our article goes over the 2026 IRMAA brackets in detail. And you can see there's a different structure for folks who are single versus folks who are married filing jointly. One important thing to know about IRMAA is that you do pay per person. So it is a per month charge. The premium for Medicare Part B is a per month charge, and it is per person. So even though it's determined based on your married filing jointly income level and your married filing jointly modified adjusted gross income, to be more specific, it is an individual premium. So if you are married and you are both 65 and you're trying to figure out what you're going to pay for Medicare, you need to multiply that by 2 because you're paying premiums for 2 people. Now, obviously IRMAA is a huge deal for all retirees, but specifically within our segment here, within federal retirees, you guys have those nice healthy pensions that you're retiring on, and that's going to be taxable income for you. Many of you may also be taking distributions from your TSP, and it's important for us to understand what income is looking like from a tax perspective in the current year, but it's also important for us to keep in mind, again, once you turn 63, you need to be looking at federal tax, state tax, if you live in a state where that applies to you, and also the IRMAA, okay? Just to understand where your income is landing you there, because the difference between taking a distribution in the middle of December and the first week of January can be colossal if you are opted in for Medicare Part B and paying those premiums, not even to mention the additional taxes, okay? So things that happen commonly that increase IRMAA. And it's okay, by the way, to increase IRMAA. I'm not saying that you should always aim to be in the lowest bracket. I am saying that you should know what bracket you're in and what bracket you're going to be in based on the decisions that you're making, okay? So we want to know the impact to IRMAA of a certain action before we do that action, okay? Things that can fool with IRMAA: large traditional TSP withdrawals, Roth conversions, both inside and out of the TSP, capital gains, right? Selling assets in the brokerage account and taking that money out. You're not taxed as income tax, but you are taxed as capital gains, which is going to go back into your modified adjusted gross income and kind of bump things up, okay? Sale of your business or an investment property. RMDs can bump the IRMAA up. This is a huge thing, and this ties in with Roth conversions. Part of the reason why Roth conversions are such a big deal is, when you turn, whether that is 72, 73, or 75, when you start taking those RMDs, that is a minimum required amount that you have to pull out of the traditional TSP or your traditional IRA, and that gets added to your income. So a lot of people get into a difficult situation where they have to take these large RMDs because they have these big pre-tax balances because they didn't do any kind of Roth conversion strategy to mitigate any of that. So they end up having these big RMDs, which then, of course, they're paying more taxes on the RMDs because it's bumping up their income. But it's also going to get them on IRMAA because they're also going to pay more for Medicare Part B, okay? Other things, pension lump sum payouts can impact it. Taxable interest and dividend income can impact it. And again, being mindful with the Roth conversions, yeah, they could bump it up temporarily, but they're not going to, they could also help you mitigate things in the long term with regard to IRMAA. The other thing to know about IRMAA, and this is my favorite thing about it, there's 2 things. One, not so fun. One, more fun, maybe. The first is IRMAA is not progressive. So this is not like the federal tax brackets where if we go $1 into the 24% bracket, we're going to get taxed on that $1 at 24%. And then the rest will be kind of 22%, 12%, and 10% a blended rate, right? IRMAA is not progressive. So if for example, right, the income limit for married filing jointly for that first bracket is $218,000 for 2026. If you made $218,001, you are in the next highest IRMAA bracket, and you will pay for 1 year that higher monthly premium amount. And if you're married, you'll pay it twice if they're eligible for Part B and opt-in as well. Okay. So the not so fun part is it's progressive. So if you go over by just $1, you are going to be in the next highest IRMAA bracket, and that sucks. But you're only going to be there for 1 year. And that's the part that's, a little bit of sugar with the salt or with the spice here. IRMAA is only impacted for that 1 year, provided that you catch it within that 1 year. Because remember, there's a 2-year look back. So if I did a massive TSP distribution from my traditional TSP in 2024, and I didn't find out that it impacted IRMAA until 2026, guess what I probably did in 2025? Probably another big distribution, right? So 24's income is going to bump up the 26 premiums. 25's income is going to bump up the 27 premiums. And then in 2028, that's where hopefully I caught my mistake in 2026 and we've leveled things out if that is the intention, right? Maybe I'm doing big Roth conversion and then I'm looking at that IRMAA increase as just another cost that I'm paying for the conversion because it is, again, temporary, only 1 year. But it's better for me to know than to get a letter out of the mail, like many of you may have gotten in the past, right? Some of you guys may have been burned on this, that my Medicare premium is going to go up because that's not fun. Okay. So the big thing with IRMAA, many of you may be listening to this and think, well, Katelyn, I'm working at 63. So does that mean that because I was working and making a full-time income at 63 that my Medicare premium is going to be huge? Not necessarily. You can appeal IRMAA. There is a process for that. But it has to be a qualifying life-changing event that increases your income. Retirement is one. You can appeal IRMAA. A lot of people don't realize this. You can appeal IRMAA and just say, listen, the year that you're basing my premiums off of, I was literally working a full-time job. And now I am retired, and that is a qualifying life event. Update this, right? Here's what my income actually is. The death of a spouse also will qualify for an IRMAA adjustment. So let's say your spouse tragically passed away when you were 64, but they were alive at 63. Your household income was higher because, again, it's based off of married filing jointly income. But now in 2026, you're filing single, right? You can appeal the IRMAA on that because that spouse who was bringing that income in is now not with us anymore, right? Divorce is another qualifying life event that will allow you to appeal IRMAA. So if you're going through that and it hits just at that right or wrong time, you can appeal that. And then loss of income producing property also. If you have a rental property and there's a sale there and that income's no longer coming in, that could also be an appeal there, okay? How do you submit appeal? You want to look at Form SSA 44, SSA 44. And that would be how appeals are submitted. It takes a couple of weeks to months for that to be processed. Again, if you have overpaid during that period, then they will adjust the premium or reimburse or however you'll be made whole if it is approved, right? Reviewed and approved. And it is a qualifying life event. Okay. So if you are newly retired and you are between 63 and 65, could be worth looking at what income used to be and what income is now and potentially requesting a review. Okay. So that's that on IRMAA. I don't want it to scare you. I think IRMAA freaks a lot of people out. Having to pay more for Medicare Part B freaks a lot of people out. I don't want you to be scared of it. I want you to be aware of it. And if you are considering a large TSP distribution, a Roth conversion, anything like that, that's going to kick off a lot of income, and you're kind of in that bracket, or maybe even in your early 60s, it could be a good time to reach out to a qualified planner and have those numbers run, right? Look at it, examine it, and know exactly, it's a measure twice, cut once thing. Know exactly what it's going to do to your taxes at the federal and state level if state tax applies to you, and the IRMAA level, okay? So don't forget about IRMAA. All right, our second article that we were going to kind of touch on in today's episode is about federal tax planning. So thinking through kind of key tax concepts around your retirement timing, because your retirement timing is going to affect more than just your pension payouts and your Social Security. It can also impact your taxes. when you are looking at setting your retirement date, and we've got a lot of great content on this on STWServe.com. We've got a great article about the best dates to retire. I don't know if you could hear that alert, so I'm going to re-record that. That'll be a cut for Jay. So we've got an article on STWServe.com on the best dates to retire for federal employees under FERS. I'll let you go to STWServe.com and find that article that will explain to you why these dates are perhaps more favorable with your pension. But the other thing you want to think about is, what are we doing to taxes, right? So your salary, your annual leave payouts, your pension income, your TSP withdrawals, your Social Security are all going to kind of impact what taxes are looking like for you. So retiring mid-year means that you only earn part of your annual salary, which could potentially reduce your taxable income for that year or place you in a lower tax bracket. Again, we want to be mindful of annual leave payouts because that comes to you as a lump sum. Remember, your sick leave is added to your pension calculation. Your annual leave is sent to you as a lump sum. Okay, so that could bump up your income because many of you aren't getting $10,000, $20,000, $30,000 lump sum payouts for annual leave every year, right? When the timing of when your pension starts, any TSP withdrawals that you're looking to make, and if you are collecting Social Security in that first year of retirement, that could offset some of your tax savings, right? Some of the tax savings of only having part of a year of income versus an entire year of income. So be mindful of that. We give you some really good examples in the article. I won't get into the deep dive here because I think it's a little bit difficult in an audio only format. But essentially the takeaway there is that the difference of only a few weeks can significantly affect your taxable income and retirement tax planning. Stuff like retiring at the end of the year or towards the end of the year. If you retire and that annual leave payout hits, you got most of your year of salary and you got a lump sum payout, that could bump your taxable income up as opposed to waiting until January, right? Right after the calendar clicks over, you have maybe a paycheck or two, and then you get your lump sum annual leave payout. Your total taxable income is likely much lower, which could give you the opportunity, if you wanted it, and if you had assets elsewhere to supplement your income, to do something, to look at something like a Roth conversion. Right? Because of course that's going to come with, that's going to add on to income and bump you kind of back up, right? So there is some strategy to that. This is not a do-it-yourself sort of situation, okay? So I would not advise, if you are looking at retiring and also doing some sort of Roth conversion, that you go it alone. We say this all the time on the podcast. You may not need a planner, but you do need a plan. And I would highly, highly, highly advise you to have a benefits analysis run and to talk through that with a qualified professional. We have plenty here at Serving Those Who Serve. You can hit us up at meetings@stwserve.com, okay? But the key factor here is that your retirement timing can massively impact your tax bracket, your annual leave taxation, and your overall retirement income. Because if you are at the end of a year and that annual leave payout hits, right? If that thing is taxed at 24% versus 12%, that could be a massive impact for you. Okay, so just be mindful of that, and definitely hit the blog to check out those examples. We get into the nitty gritty and kind of explain it at a much deeper level, but this is bite-sized edutainment content for you, just to kind of jog you to learn about these things. Okay, so definitely check out that article. It is called More Than Pensions, Understanding Retirement Federal Tax Planning. Okay, so take a look at that. All right, friends, and that is actually all the time that we have today. Time flies when you're having fun learning about federal benefits. But we will absolutely be back next week. And Dan, hopefully, my wonderful co-host, my stalwart, dapper fellow, will be back with me so that we can make sure that you have all the latest updates that you need to make informed decisions about your career and your financial well-being as a Fed. And to make sure you're here for that episode, make sure that you are subscribed to this podcast wherever you are listening to us, whether that be YouTube or Spotify or on our website at STWServe.com. That will help you never miss an episode, and it will also tell the algorithm that this is important and relevant content that they should show to more Feds. So you're helping your friends and colleagues. If you want to do that in a more direct way, you can send them this episode. If you've got somebody who is getting close to Medicare age, feel free to forward this episode on to them, and maybe they'll learn something that is important. It's always good and goodwill to help our friends and colleagues. Now, for more information on the topics that we talked about in today's show and more, I've already mentioned it a couple times, hit STWServe.com. While you're there, you can subscribe to our newsletter, The Weekly Serving, to get all the latest news for feds delivered straight to your inbox every week. And if you want an opportunity to dive even deeper into learning about your federal benefits and financial planning for feds, we encourage you to join us for one of our complimentary webinars. We've got a couple great ones coming up. We have one of my all-time favorites on August 11th from 11 a.m. to 2 p.m. Eastern Standard Time. I am going to be presenting the financial planning webinar, and Dana is going to be my host for that, my co-host there. If you have never had a webinar with us, if you've never been to one, this is a great one to start with because we kind of touch on fundamentals all across the board. Okay, so we'll touch on a little bit of everything, and then you'll have your choice as to what you want to deep dive into with your next webinar. But that is a great starter webinar. And if what we were talking about with regard to tax planning was particularly interesting for you and you want to hear more about that, on August 13th from 1 p.m. to 4 p.m., we have a tax planning webinar coming up. Ed Zerndorfer, the one and only, is going to be hosting that one. He's going to be presenting, rather, with Jen Meyer from our team, from the Serving Those Who Serve team, as his host. So highly recommend that tax planning webinar on August 13th and the financial planning webinar. To see all the webinar offerings we have available, you can hit stwserve.com and just click on webinars in the top right corner. If you prefer a one-on-one approach, because I get it, you're busy, you may not have a couple of hours just set aside for a federal benefits webinar, feel free to reach out to our team directly for a financial planning consultation at meetings@stwserve.com. We would be happy to talk through any of your benefits with you and help you kind of get your hands around it, because I know federal benefits is really dense and it can be intimidating to learn about. But you deserve to get the most that you can out of your federal retirement. Okay. So happy to help you do that. And with that, thank you so much for listening to the Fed15. I am Katelyn Murray, and we will see you next week. Take care.